you can develop a positive mindset and a positive attitude toward life, no matter what comes. See, it's not a matter of you're gonna have hard days. It's just a matter of how do you see those challenges when they come your way.
Whatever the mind can conceive and believe, the mind can achieve.
Welcome to the Dream Big and Think Different podcast, where we inspire, impact, and empower.
Progress is impossible if you always do things the way you have always done things.
It's time to dream big. Here's your host, Dr. Sachin Maskey.
Welcome everyone to another episode of Dream Big and Think Different podcast, where our mission is to inspire, impact, and empower millions of people. I'm your host, Dr. Sachin Maskey, and today we have a very, very special guest who is another dreamer, Mr. James Aquila, all the way from Dallas today. And I'm super excited and pumped today for this wonderful episode. I want my listener to definitely listen to this and learn a lot of good things about the most important topic we're going to talk about taxes. And I'm honored and privileged and very excited again to have my brother in the show. James, how are you doing today?
Man, I'm doing amazing. I know it's exciting to be on this call. It's exciting to be on your show. Every time you and we get a chance to connect, is always, magic happens. So I'm excited about what's going to happen today.
Absolutely. So a little bit background, how I met James is about probably 2 years ago. I met him first time in Vegas. We were part of the mastermind and with Craig, I think. And that was the first time I met. And after that, we started talking in full disclosure. He is my tax, advisor. I recently joined to do all my taxes, and I'm again super excited. The one thing I like about James is down to earth. He is easy to work with, and he makes taxes so simple that the 5 years old can learn and take advantage of. Simplicity is the key. So that's what he is about. And again, a little bit bio about him. Formally, I would like to say, he's in short, entrepreneur. He's an investor himself and also a traveler. And recently, he came to our Dartmouth to support our cause, for my nonprofit, Donna Yuga Foundation. And I was, very happy to meet him in person again. So about him, a little bit, if I miss something, please, James, you can add on, okay? He has with over 11 years of experience in both tax and finance. James Aquila is the CEO of Aquila Finance and the Tax Service, a company that provides financial analysis, tax consulting, and strategic tax advice to the client and business owner across the various industry and sectors. James holds and enroll is an EA certification from IRS, Internal Revenue Service, and a certified tax coach designation from American Institute of Certified Tax Planner, demonstrating his expertise and professionalism in taxation planning. With that, I'm going to start our topic for today. It's 5D of taxes. And first question for James, I'll ask everyone before we go into a topic is knowing more about you, which is who is James Aquila and why he's in this world?
Well, man, that's a good question. I like that. I really do. I always say that I believe we are on this planet to be able to serve others, right? That's our biggest mission, is to find something that we love to do with passion and then utilize that to serve others and make the world a better place, right? I was born in Yambio, South Sudan. It's it's actually one of the youngest nation in the world. Got its independence in 2011 or so, right? And I'm the oldest of 110 grandchildren, right? So every time I go home, it's like the whole village, which pretty much is my family, right?
Right.
So
That's amazing.
Family is major to me. Family is very, very important because I believe that's our legacy, and everything
Absolutely.
that we do is to be able to pour into them. So, in a nutshell, really, I'm just down to earth. I love to travel. Matter of fact, I'm traveling as we speak right now. In that aspect, and
Yeah.
that's one thing I love to do. Is like I'm passionate about that, and then I love helping people. So it's simple way as far as who James Aquila is. Outside from the tax office and talking about taxations and stuff. That's you'll catch me on a beach or on a flight somewhere completely random. You know.
That's amazing. So thank you for sharing that. I know this our whole podcast is dream big and think different. So I want to go a little bit about your childhood before we get into the topic of 5Ds of taxes. So tell me, what was your childhood dream?
Uh, so I had many, and of course I've had many, throughout the time. One was to to play professional football, right?
Really?
Now,
Okay.
not American football. I'm talking about like soccer,
The
right?
soccer. Yeah, yeah, absolutely.
Because around the world, football is soccer,
Yes, yes.
And
So that's
so
really okay.
a funny thing about that is though, so when I got here to the U.S., I in middle school we had a football team, of course, and so I signed up thinking that I was signing up for football, which is soccer. And then, of course, my first day of practice, they handed me all these pads, and I'm like, "Wait a minute, this is not, we don't use this for football." They're like, "No, it's American football, not."
That's funny. Yeah.
Yeah. So playing football, was one. I would say, you know, well, I always wanted to be in the military, and of course I was able to accomplish that, serve about 8 years in the Marines. And so, of course, throughout time, my dreams changed as my
Absolutely.
perception of life changed. The more exposures that I have to different people and different culture, that cultivate my vision overall as far as life too. But just a simple one, I wanted to be a professional football player. Could I
Yeah.
have my Aquila out there?
Yeah, that's a beautiful dream, and absolutely every times we with certain age, I think there's a different dream for all of us. So what I think is dreaming is one of the important part of life. If you dream such a big thing like hitting the when you shoot for the stars and you can land out to the moon. There's some saying like that, which I like it because if you dream big, and you can achieve a lot of things in life. So but I think that's thank you for sharing. So one more question I have before we delve into your main taxes thing. So what inspires you every day and makes you productive every day?
So my biggest inspiration, like I mentioned earlier, is my family, right? Someone was brought this to me and they said like, I
Hmm.
may not have come from a wealthy family, but a wealthy family will come from me, right? And so
Absolutely.
a lot of the time when I travel home, when I go home, I have families over in Uganda. I have family in South Sudan, in Yambio and Juba, and so my biggest inspiration is always showing them that they too can be able to live their vision. I believe that people don't need charity; they need inspiration, right? They don't need
Absolutely.
charity, they need inspiration. They need to know that you are living your vision, you're living your life. And so when you come and tell them that they too can do it, you're coming from a point of of demonstration, right? You're demonstrating that greater is he that is in you than he that is in the world, meaning that, hey, listen, there's more power within yourself that whatever your mind can conceive it can achieve, right? And so that's my biggest inspiration is my family. Every time, everything I do, I always want to give them more opportunities in the world, because as they see me succeed, they unconsciously give themselves permission to do the same thing as well.
Yep,
So
yep. Yeah, I totally agree. And for me also, I tell my kids and everyone I talk to, with the true wealth. What is true wealth, right? So for me, is not actually money, like money, but number one for me is a health. Being a doctor, I think as a bias, but health is number one for me, and number two is a family, which you just mentioned. Family is
yes,
everything. Without our dad and mom, we won't be here talking. you know, and and number two will be freedom, freedom
yeah,
of money,
yes,
time. Just we're going to talk about now the next topic about taxes. How, as you all know or hear, this the biggest expense of life is our taxes, right?
absolutely.
So James is going to tell us more about the 5D now. I'm super excited. Everyone listening, I would recommend to definitely focus what he's saying and maybe have ready with pen and paper and start writing. Yeah, go ahead,
No,
brother.
absolutely, man. Well, thank you so much. Once again, I can't be, more grateful for the opportunity to just share my passion. I love what I do for work. I love what I do to be able to help, family, be able to either that's helping them get a bigger refund on their, on their taxes, or helping them reduce their tax liability, which allows them to keep more of their money. But at the end of the day, we truly do a service work for, for America, right? So when it comes down to it, I had to understand. It took me 12 years to really fully understand the taxes, the tax game, how it works. And what I really realized is if you plan properly, you can always succeed, right? You have to build your financial future. You have to build your your tax future, how you want to, to file. These things are so vital as far as being proactive than being reactive. Now, the
Yes.
IRS states that about 93% of business owners overpay on their taxes, over 93%. And the reason being is because majority of people are reactive with their taxes instead of being proactive. So what I want to talk about, and I call it the 5D's of tax planning, is no matter what you do. So somebody will come to me and say, hey, James, I think I thought of this idea, or I'm going to utilize this strategy. And then immediately in my mind, I already know where it falls, where it
Absolutely.
falls in those five, right? Because the first one, the first D of the tax planning is deductions. Okay, so what is a deduction? The IRS states that whatsoever is necessary and ordinary, these two category defines what a deduction is to your business. And so of course the tax planning really helps more business owners than it does to W-2 employees. But one of the things I love to do is be able to combine the two. And what I call it is like the hybrid scenario where you have a business and you have a high net worth, W-2 incomes. And then when you combine those two through like real estate and, other investing, things of that nature, you're able to see, benefit from both worlds. So the first one being deductions, right? A deduction can be, you utilize your vehicle for your business. So you can
Uh-huh.
go purchase a car today and be able to depreciate the value of that. But now what you're creating is paper losses, not actual, a loss, because when you do a depreciation, you're evaluating how much the vehicle is worth or how much the house is worth. And the IRS give us a timeline that we're able to, take the value of it. And if you do a bonus depreciation, you're able to take more of it. So the first D being deduction. And so it's so important that you take full advantage of all of the deduction that is available to you. So that way you're not overpaying. Because if, let's say, for example, you forgot that you can hire your kids to work in your business. Now that's a deduction that you could be able to write off. But because you did not know, guess what's happening? You're paying more in taxes now, right? You're paying more in taxes. So it's crucial that you keep that in mind. And then, like I mentioned, Dr. Sachin, I do have a list of over 300 different deductions
Wow.
that anyone can use. Now, I always say this, like, make sure you use what applies to you. Now, not all 300 is going to apply to one of your situations. Right? But I wanted to make it easy to say, hey, listen, if you are in this field, these are potential deduction that you definitely need to be looking into, so that way you're not overpaying. So that's the first one. And
So,
one.
question about deduction, since we're gonna, I mean, we're gonna go all these, but so deduction, I think everyone probably knows about it, but there's something called standard deduction, right? I think everyone can probably, if you go to this HRN block or whatever, regular tax returns. I used to do that like 7, 8, 10 years ago, and they
Absolutely.
used to apply that standard deduction, and now we're talking a little bit more than standard deduction one,
Absolutely.
and I think the
Absolutely.
question is like, what is the difference? If you can
Perfect.
explain that.
Perfect. I'm glad that you mentioned that and you're able to separate the two, because there is a difference, right? There's a difference, when it comes down to it. So there, when we talk about your business deductions, this is what I call, above the line deductions. Okay, so now not to get too complicated, because once again I like to simplify it, right? So
Absolutely.
what happens is when it comes to your taxes on your 1040, the 1040 is a summary page of all the source of income and expenses that comes to you. So now, once let's say you have a W-2 and you have your business, all of those are going to be calculated to determine what is your total income is going to be. So it's going to calculate it to total income. And then once it's completely calculated, now this is where the 300 different deduction comes in, right? It's going to be on your business to determine what your income is. So if you make 100,000, for example, on a W-2 side, and then you made another, 100,000 on your business. Now, the deduction I'm talking about right now is going to apply directly to your business to say, okay, we have 100,000. How do we reduce it down to 50? Because the chances are when you made the 100, you actually accumulated expenses in the process, right? So that's what I'm talking about is that deduction. So that 100 becomes 50. Let's say, or let's do 40, 60. So that means 60,000. 40,000 was used as an expense to generate that 100. So now your profit, your net profit on your business is going to be 60. So therefore, your total income is 100,000 on the W-2 plus the 60,000 on your business. Now remember, we started with 200, right? 100 from the W-2, 100 from the business, but because of the deductions, we reduced it down to 60. So now your total income is 160, right? So now you have what's called your standard or itemized deductions. This just means what is your filing status. Your filing status is going to determine the amount of your standard deduction, because based on the IRS guidelines that's already in place, and I'll utilize 2013 since we're still there, right? In 2013, no, not 2013, 2023, okay? 23. The standard deduction for married couples was 27,000. Okay, was 27,000. So that's a standard. So you still have that 160 of income. Now, guess what? What happens is your standard deduction, if you just take that, you subtract the 27 from the 160, and it's going to determine what is your taxable income.
So you can still apply your standard deduction after the business deduction.
Exactly. So it's not either or. It's both. Now,
Wow.
what is either or is that you have standard deduction and you have itemized deduction. Those
Gotcha.
two are, you have to choose one or the other. Okay, because the itemized is, for example, your property tax, your mortgage interest, your gift to charity, and medical expenses. That determines what your itemized deduction is. Now, when you compare the two, if your standard deduction for married filing jointly is 27,000, but your itemized came out to be 20,000, then you would just take the 27 because it gives you more deductions for in that aspect, right? So there's the business deduction and then the general standard deduction or itemized that applies to everybody, no matter who you are in that aspect.
That's amazing. That's amazing. So let's next D.
Okay, perfect. The second one is also one of my favorite, right? I'm sure I'm going to say all of them are my favorite because at the end of the day, it's all saving us money overall, right? The second one is called defer. Defer. You can defer your income. So the first one was you can deduct your income. The second one you can defer. You can deduct your expenses. The second one you can defer your income. Now, what is it? What's deferring? Basically, when you choose to defer your income, you are choosing to delay the taxes on the income right now to a future date, right? So, for example, when you have a 401k, you put money into it. You put a portion of your salary into your 401k. Now, and then the company will match that portion or whichever the case. But whatever is being put inside of that 401k is being delayed till future date. Sometimes 59 and a half. That's the time frame without any penalties, right? And then and then beyond that time frame. So that's what's called deferring. So some of the things that we can defer, you can utilize a solo 401k for business owners. Okay. And the thing about utilizing solo 401k or SEP IRA is the amount that you can be able to defer is so much more than traditional IRA for individuals. Because for individual, you're capped about 6,000 or 7,000 in that aspect. But on a solo 401k, you're able to put away 25% or even a signal $68,000 into these accounts. So it all depends on your circumstance, what your payroll is, all of that aspect. So what we do is we evaluate to see how much can be deferred utilizing that concept, right? So deferring allows you to be able to not take the money right now, but defer it till later. And so therefore, because you're not taking it right now, you're not calculating that on your income for that year. So therefore, you're not paying taxes. So it's a very strategic move that that you can utilize to be able to minimize your tax liability or your tax exposure, because also it can play a good role for you. Because think about it. Let's go back to the same scenario that we used earlier. The same, in a gentleman, he has 100,000 on a W-2 and 100,000 on his business. Reduced it down to 160. So now his income, his AGI is 160,000. But if let's say 2 years from now, he loses his job for whatever the case. Okay, his business is still there, but he loses his job. He can be able to take the income out of that 401k, or be able to take that he was deferring, and now he can to show more of his income currently, but it will still show him, it will still put him at a lower tax rate because he is not adding that 100,000 plus the 100,000 plus whatever he took out of the 401k, but he's just adding that 401k to his current. So a lot of time, strategically, you can decide when you want to take the money. And of course, we have to factor in penalties or interest depending on the circumstances. But these are ways that we can be able to control our tax exposure overall in that aspect. But everything that I'm talking about is all based off of strategic planning, being proactive as far as how we want to do things.
So that's a good one. So I have a question on the deferral aspect. So in real estate, like specifically, I think there's a concept called 1031 exchange,
So
right? So
that
do
is
you think that's another deferral way to, like, as a 401k, same thing in 1031, when you sell the property, any investment property, there's a capital gain. So if you do a 1031 exchange, you don't have to pay tax when you sell at the time of the
absolutely
property, correct? That's
that
kind of
is
one of the deferral.
yes. So that would fall under a defer concept, right? But now that's interesting that you brought that up because that is actually part of my other D that is also the last one.
Uh,
But that is part of the deferring because what you're doing is you're transferring the sale or the capital gains from that one property into
right.
another. So instead of choosing to recognize the gains right now, we're transferring that into another like property and then be able to continue the same this
Sure.
process in that part. But yes, that's a good question.
Yes, there's another one in deferral. I don't know if this comes into this D also, like that. Like there's some kind of the student their plan like 529, something like that. The
529 plan.
Yeah.
So you
Uh,
can put funds into it, right? But then you get to utilize it for college, right? So you
right.
get to utilize it for college. Of course, anything that deals with tuitions,
Yeah.
and then, but if your child that chooses that they don't want to go to college, then of course at that point you would have to pay the taxes
Sure.
on
So the question was, is that also one of the way to defer the taxes?
that is one of the ways because you're putting it into in a structure that allows your income not to be taxed currently, right? And an HSA account is also a good one to be able to to look into
Yes.
as well.
Yeah,
And
because all these are, when I sign this enrollment form every year with W-2, I think these are three things we need to choose. One is 401k, one is SSA, and then 521 plan. So I
yep.
think these are all deferral comes in the heading, I was thinking.
Exactly. These are all deferral structure that is designed there to be able to help you reduce your tax exposure overall. So I always recommend, listen, if your employer is providing all these different benefits, take advantage of it. Right, take advantage of them so that way it shelters more of your tax of your tax exposure of your income from taxes overall. Because otherwise, like I mentioned, I always say this: the people that pay the most in taxes are the uninformed, right? They are the uninformed. And so in this concept, this podcast, the more you make yourself informed, the more you learn how the IRS code work, you put yourself in a more favorable position to make sure you keep more of your money in that aspect.
You're listening to the Dream Big and Think Different podcast with Dr. Sachin Maskey. Be sure to stop by sachinmaskeymd.com to download a free copy of Dr. Maskey's book.
So number 3, what is 3D?
Number 3. So number 3 is also one of my favorite, right? So if you have children, this is going to work very, very well for you. And this is where you set up like a family management, a company, things of that nature. So it's really about hiring your children to work.
What do you call that D?
Say that again.
What do you call it?
Oh, perfect. I already dived in. See, I told you I'm excited about it, right? So this one is called dividing your income, dividing the income. Okay. So divide. So you can deduct the taxes. You can deduct the expenses. You can deduct, you can defer the income, and then you can divide the income in this aspect, right? So this one works really well when you have children at home, because we all know that children are expensive, of course, right? But a lot of their expenses, like the after school program, the school track, things of that nature, those are not tax write-offs. They are not at all. And so the thing is that you can be very strategic about it. Is if you have a business, you can be able to now teach them how to be responsible adults. Start create a job title for them, create a job that they can actually do in your business. And the beauty about that is when you pay them, the strategy is to not pay them more than the standard deduction for that year. So, for example, for 2023, the standard deduction for a single individual was about $13,850. Right, 13,850 was the max that someone can earn without having to pay taxes. Anything above that, now it falls into the 10% tax bracket, the 12, the 22, and so forth. So in this aspect, you hire your children. So if they're going to be costing you money anyway, why not put them to work, okay, in your company, and then have them on a W-2 salary, and then in that aspect, and then pay them. Now, the beauty about this is that once you put them on a salary, or once you put them on a payroll, they now have what's called earned income. They do have to file their taxes, of course, right? But there won't be any tax liability because they didn't make more than the standard deduction. Or if they did, and let's say the job that you have for them, consider that you do need to pay them quite a bit. Well, even if you pay them 20,000, okay, or you pay them 15,000, the amount that is over the standard deduction is subject to about 10% taxes. So in their scenario, they have very limited amount of taxes. To you, maybe by $300, $400, $500. But if it was applied to your income, you would be paying quite a bit, because that same income will be taxed at 37% tax bracket, right? So it's a strategy to be able to divide the income within the family. But back to the children. So now they have earned income. You can actually open a Roth IRA for them. You see, because they have earned income. So starting them very young, start to put money into their retirement account at an early age, gives the opportunity for compound interest to actually work in their favor. Right. So these are different strategies that parents can be able to utilize. Dividing the income is major. It's really just putting your children, send them up financially early on. Now, here's one. This is just an extra. If you really want to if you really want to help them even more, add them as an authorized user to your credit card. You see, right? So now they have earned income. We can open a Roth IRA for them, and they start building a good history, right? On their credit cards. So therefore, by the time they reach 18 or so, they now have a stabilized history. So what you have done is you're not only preparing them to be a responsible young adult, but you're also setting them up to be responsible with their finances as well, right? So these are, so that's the
That's
dividing the.
amazing. I was just writing in children. This is something I'm really looking forward to do also for my taxes. And I think three things. One is you said. One is definitely the earned income with less tax bracket, so that you don't have to pay a lot of tax. Number two is a Roth IRA we can open for the children, that
Yes,
their retirement you can set up from, like, 10, 12 years old, whatever. And then when they are retired, they probably have, just by this Roth IRA, we're talking millions of dollars. Um,
exactly.
and last, the credit history that you mentioned. It's amazing
Exactly.
strategy.
That's
I really appreciate this one, because something I'm looking forward to do myself. But let's go to number four.
okay. Perfect. So, right. So now number four, I call it Dodge. People always look at me sideways like, "Why'd you call it Dodge?" Because I needed to keep
I like the
the
name.
keep the 5D's in, and the dodging aspect was perfect. So really, what that is income optimization. Entity optimization. So dodging. So dodge the. So what we are doing here is we're doing an evaluation and we look at how your business is currently structured. Because here's the thing, the entity that you operate within is also going to determine how much taxes that you're exposing yourself to. Right. So when we're looking at how your formations are set up, if you are operating as an LLC, there is zero tax advantages inside an LLC. Zero. Aside from, now I call it LLC. It's a limited liability corporation or a company, right? But we have our own inside joke. Is like an LLC stands for large lawsuit coming. Okay,
Last lawsuit coming. That's
a
funny.
large lawsuit coming. But an LLC is more of a state and a liability in a entity structure. It's not. It doesn't really do anything for you when it comes down to your taxes because you're still considered as a disregard entity. Now, here's what we, in also within LLC, you have what's called self-employment tax, which is about 15.3, based off of the income that is your net income that's left. So in that part, it really does add more taxes to your platform by operating inside of an LLC. Now, here's the misconception because everybody, they listen to TikTok or they go on YouTube. They're like, man, I should set up. My suggestion is always this. Now, continue, do operate as an LLC until you start to show a net profit of about 50 to about 60, 40 to 60,000 in income. Then at that point, it is necessary now that we do income optimization, entity optimization. What that means is by, let's look into selecting an S corp. Let's look into that aspect and see how much taxes are we going to be able to reduce by simply changing the entity structure, because now instead of you being taxed as an LLC or the disregard entity, you're now you are an employee of your entity, right? And then from there you start taking salary. So that structure alone could save you tens of thousands of dollars depending on how much your income is earning. And so just by restructuring the formation of your business, now you're able to dodge the self-employment tax. That's where the dodging comes in, right? And so you're really not dodging, you just basically restructuring to put yourself in where you're not having to pay such a high self-employment tax on the profit.
So just a question about that, clarifying. So I like the concept, but sounds like a little bit complicated to understand
Okay.
properly until you do it. So let's say you have an LLC. So I have like more than 15 LLC, and
This
if
is
you
true.
go down everything. So you're saying that the LLC, there's no tax benefit, which is kind of true, uh, but you can elect the tax election either S corp or C corp, correct?
So you can, from an LLC standpoint, right? So you do have to form the LLC itself, and then you can make an election to be taxed either as a
That's
C,
right.
make the election to be taxed as a S corporation, or we can sell, we can make it as a C corporation in that aspect, right?
And then you
So
can benefit the tax benefits.
that is correct. That is correct. So because by making that election, now once again, it is a form that you have to fill out, and send that over to the IRS. Now, once you fill out this form, you send it over to them. They have to approve it. So we can't just say, "Hey, I make the
Okay.
election." We have to wait for the approval from them, and then from there, they're either going to say, "Hey, as of January
Okay.
1st, 2024, right, you are now classified as an S corporation to moving forward." So
Gotcha.
in that
And
aspect,
then
yes.
one thing, there's some process involved here, which you know exactly what to do for the listener. And then I think one of the things you mentioned is LLC needs to make money, and this with a zero income, then it's not going to be valuable, right? So
Exactly.
$40,000. That's what you said.
I would say about, and it starts to make sense once you show in profit about 40, 50, 60,000 in,
Okay.
in net profit, because
Okay.
now you're starting to recognize, you're starting to see the self-employment tax on your tax returns. Because before then, it doesn't, the administrations of an S corp or administration of a C corporation may be more cost, it may actually cost you more to just run it than the
Gotcha.
benefits that it's providing you, right? So
Yeah.
we always want to wait until we actually generating enough income to
Sure.
justify the the
So
expense.
one quick question on that. So what would be the some one or two example that you can utilize after having that corporation form, like election done, C or S, based on the number of employees, whatever? Like how do you help to lower your taxes then?
How does it lower your taxes? Is that what you're
Yeah.
asking? Okay,
Yes.
so here's what happens, because when we're evaluating the scenario, and so there's, like I mentioned earlier, the 15.3 self-employment tax is attached on the profit of the business. So if you're just operating as an LLC, then all of that, and you may, let's say, just to keep it simple, you netted 100,000 as a net profit. Now, so you still have, so let's utilize our gentleman, our illustration gentleman earlier. Okay, so this time we're going to keep his income at 100,000. So he has W-2 income. He has the business, but his business is an LLC. So now he shows income at 200,000, whichever the case. So therefore, and then so he has what's called income tax. Okay, so the income tax is based off of that 200,000.
Mm-hmm.
So therefore, the first 13,000 is taxed at zero. There's no taxes on it. Then after that point, it starts going up the tax bracket, right? Because it's a ladder that keeps going up. Then that's the first part of taxes. Then the second part of taxes is going to be income, self-employment tax. So his business net profit 100,000. So in this scenario, there's 15.3. So that's another 15,000 of taxes added on top of his income tax. Are you
Okay.
following me so far?
Yes. Yes.
Okay. So in that scenario, he winds up paying quite, you're talking about 40, 50,
Significant.
60, which is significant amount of taxes. So now what we'll do in this aspect, let's say we reclassified, or his business taxes. So he makes the election to be taxed as an S corp. What is, the major requirement is he has to take a reasonable salary. Okay, he has to take a reasonable salary, which taxes are already being paid, or every time he received that W-2, the withholding is already done. But now that 15.3 is actually slashed in half, because the other half
Okay.
is going to be taxed at the corporation level. He gets to write it off. So it's a deduction to him, because as a payroll tax, payroll taxes. You follow me so
Mm-hmm.
far.
Mm-hmm.
And then the other half is income tax. Okay, so so if you look at it, so that 15.3 is divided in two, because one is is the employee side, and then the other one is a payroll. But because when you're self-employed, you're paying both of them together. But when you become employee of your business, you're now able to divide those two, and then one half is a write off. So these are just to try to simplify it as much as possible. But a lot of the time we go through that aspect, we analyze it, and then we just show this is how much taxes we are able to save, by making this election right here.
Sounds like it's a very good strategy, but look requires a little bit of analysis, and that's the reason you're here to give us
That's
some
that's
advice.
that's what we're here. That's why we got tax expert, tax advisors.
And one thing I would like to disclaim everybody is this is not a legal or financial or actually tax advice. This is just experience we are sharing with you guys. And if you really wanted to please consult with your CPA or your tax advisor and basically become a client with James Aquila, and then you can get an individual tax advice. We're not giving any Like it's basically education purpose
Well, is
only
it
and
this? Yes, this is
high
just
level.
more of a
Yeah.
conversation. More of like,
Yeah.
hey, what can be done? But
Yes.
your specific scenario has to be analyzed, and then
Yeah.
the advice has to tailor made
To
to
the
you,
specific.
right?
Absolutely.
Exactly.
Absolutely. So we have a last one here because of time. I think we're already 39 minutes here. So
Yes,
what
sir.
was the last D, sir?
Oh yeah, so the last one is very simple, and is it really boils down to into the real estate world. So it's just a difference between long term capital gains and short term. So I call it disguised, right? Disguised. So
This
the last
guys.
thing, disguised. So it really just falls down and said, okay, hey, we have an asset, right? We have an asset here. If we hold it more than 12 months, it becomes a long term capital gains. If we sell it after 12 months,
And
or
this
if we
applies to both primary like investment property or just investment property?
No, it applies to investment in general, right? Because any asset,
No, no.
what
So the primary residence, for example, right?
well,
Does it
okay, I
apply?
saying, so your primary residence, does not fall in under this because it's more
Gotcha.
of, this is more applies to like investment properties in that
Rentals
aspect.
and all that. Yep.
Exactly. Now, your primary resident, you do have an exclusion actually that is already in place, so that
Yep.
way you can be aware of. So, if you are single and you have a primary resident that you've lived in for 2 out of the 5 years in that aspect, then you have up to 250,000 of the capital gains that you can actually deduct.
I think it depends on the state too, and whichever state. I think in Massachusetts, 500,000 something. So
Well, so if you're single, it's 250,000. But
okay,
if you're married, it's 500,000, right?
okay,
So
but you have to live for 2 years, right?
but you do have to have lived in that property for 2 years, and it has to be your primary residence. Exactly.
Gotcha, gotcha.
Yes, sir.
That's it.
So that's mainly for your primary resident. But then there's other rules, as far as a 12 months or less applies more for investment properties, things of that nature. So it really boils down to a lot of the time when we are having a conversation with clients and they have an asset, they say, okay, well, if we hold off for another month or two, then it'll fall under the long term capital gains, which is a little bit more favorable position to be in. So why don't we go ahead and hold that asset? Don't sell it just yet. Or if if everything falls in place and it makes no difference whether we sell it right now or later, then of course we go ahead and take that short term capital gains in that part. So really, the last D is just disguise. It's just disguising what type of gains it came in, whether short term or long term. So when it comes down to it, no matter what you do, when it comes down to tax planning, it's gonna fall under the umbrella of these five, right?
Hmm.
It's gonna fall under the umbrella. And so the more knowledgeable you are about how they operate, the more you know which chess piece that you are moving and how it applies to your taxes overall,
Sure.
right?
So
Look,
James, the last one, disguise. I'm still trying to figure out how you're going to lower the tax. So what is the strategy here?
so, well, when it comes down to it, so short-term tax, capital gains, you have a different it's taxed at a, higher tax percentage versus long-term capital gains, right? So long-term capital gains, I believe right now it's about 89 or 90,000 that you can show at a zero tax, taxes attached to it, right? So therefore allows you to be able to show more income or more profit, but at a lower tax rate. So it just, it all just depend on how long you hold it is going to determine what taxes or how much taxes that is exposed to it.
Okay. And this
Yeah,
only applies to real estate or any, like, let's say you have a stock,
stocks as
market.
well. It
Okay.
also
Same.
applies. Mm-hmm.
Okay.
And then,
I think this guy's in real estate. What I would like to tell the listener, because I'm in real estate and we're actually starting our fund. Two things. One is bonus depreciation, which we didn't talk about it. Is also a major tax benefit, and we're gonna have another episode just to talk about how,
correct.
as a investing in real estate, you can lower your taxable income if you are rep status, real estate professional status, or basically if you are W2 income also you can basically lower overall your taxable income. There are a couple of strategies we can discuss, but that's one bonus depreciation by doing cost segregation study.
Yep.
um, then other
Now,
one is 1031 exchange we talked about briefly, and guess what, there's another one. There's something called opportunity zone. If you invest in a property in opportunity zone, the 2017 tax job acting Congress passed this law. If you have a capital gains, for example, and you invest in the opportunity zones, you pay zero tax if you hold a property for 10 years.
Yeah.
Those I think I learned by investing.
These are all great. I mean, these are definitely great. So, because in that aspect, that falls under the deduction
Yeah,
aspect, right? Because it's like you having five folders in your table, and then
right.
you take one folder, and inside of it, we have depreciation, we have the opportunity zone, we have all these different strategies that can be done in each one of those folders, right? But overall, those are all great concepts. Those are all things that can be able to to lower your taxes. My only advice to everybody is that do not wait until December 31st to try to think of what should have been done, right? Be
Yes, yes.
proactive about taxes.
So, rest to give 5Ds again. Number one is deduction. Number
Mhm.
two is deferral. Number
Yes.
three is divide. Number
Yes.
four is DAWs, and number five is disguise.
Yes,
Man,
sir.
this is amazing, and really, really think this is a good strategy. The I have two last question.
Okay.
Second last question is, James, what is the biggest win in your life, and how do you define success?
Oh man, the biggest win in my life. So I was, so when it comes to the biggest win, it'll be my team. We have a very, when it comes down to it, it's someone once told me this. It said, if you want to go fast, go by yourself. If you want to go far, take a
Far.
team with you.
Okay.
If
Yeah,
you want to go fast, go by yourself. If you want to go far, take a team with you. And so I would say my biggest achievement is we have a really great team. We love what we do, and we work as a family. Right? Everybody on
that's
our team,
amazing.
we know each other, and so if there's any issues, we can be able to take care of it as a team. So that's, I would say, one of our biggest achievement as well. And then of course, just being I would say my biggest thing I'm always working on is my mindset overall, because if you can develop a positive mindset and a positive attitude toward life, no matter what comes. See, it's not a matter of you're going to have hard days. It's just a matter of how do you see those challenges when they come your way,
It's like
right?
fell forward.
Exactly. Go forward, keep achieving, and keep moving
Yeah.
forward. Yes,
So
sir.
once we all will have challenges no matter what, but once you don't give up and keep on, if you fall, keep on, get up and do your thing, and that's what matters. And I appreciate that. The
Exactly.
last question for today is simple question: where people can find you, and what is the one thing you want to share your wisdom before the show?
Man, one thing I wish is well, it's completely not tax related. Go out there and travel and see the world, because
I love
go
it.
out there,
The
travel,
beautiful world we all need to see.
big world. It's a big world. It's amazing. But overall, of course, when it comes down to taxes, I say, be proactive about, your investments, be proactive about your finances, because at the end of the day, it's life is not really, it's not all about just working to pay bills. But if we are wise with, what we do have, we can be able to live life a little bit more less free, and we don't have to worry about the taxes too much as well, right? So overall, breathe. You got this. Hey, listen,
Absolutely.
you are alive. You're breathing. Live, live life to the full.
Absolutely, absolutely. Where can people find you?
So, of course, you can, reach out to me by, going to our website, www.aftaxservices.com. You can always reach me directly at my, the phone number, 817-374-5049. That's my direct line. And we can set up a time and have a conversation. I call it a virtual coffee. Right? Let's just sit down. Let's discover whether we have a mutual interest of working together. What can we do to be able to, to change your circumstances? So there's other two ways.
Sure. Thank
Yeah.
you so much for doing that, sharing the information. So you mentioned that you're going to provide some 300 ways to deduction.
Absolutely. So when we finish it, I'm going to be able to. I'm actually going to send you, an email with the list, so that way you can provide it to your, to your audience. Another
Sure.
way to be, that they can also just be able to get it directly is if they text the word "get started" 972-627, right, 4776. So 972-627-4776. So if you text the word "get started" to that, it will automatically, actually send you an email. So all you have to do is type in your
Absolutely.
email. They will automatically.
So, yeah, all this information will be provided in the show notes again. So, again, this is amazing. This is really honor, and I like to thank you from my bottom of my heart. I really appreciate all the expertise and all the golden nuggets. This is something we all need to kind of get involved, because as we know, again, the tax is the biggest expense in life. And if you reduce by taxes just by 50%, just listen to this, just by 50%, instead of working 40 years from 20 to 65, you're going to reduce your freedom by half. So I will really think this is very, very powerful. We're going to have another episode with James down in the future, but I would like to thank you again for all the expertise and sharing the wisdom with us. Anybody watching this or listening to this, please, I would recommend to like and subscribe the channel, and also share with your family and friends so that they can also reduce their tax, and we can help each other in a long way. Again, thank you so much and have a great day.
Thank you so much. It's a pleasure being here.
Thank you for listening to today's episode of Dream Big and Think Different. We hope you enjoyed it. Please be sure to subscribe to our show so you don't miss any gold nuggets. And we'd appreciate it if you could rate and leave us a review on iTunes, Spotify, and other platforms. Until next time.